All right, hello everybody. This is Mike with the Netpicks Inner Circle. In this week's options trade of the week, we're going to take a look at Apple. Market wide, we have seen a very impressive run back to the upside over the past week and a half. In fact, the Dow was actually up 7 days in a row. You take a look at the Apple chart, we're actually up, I believe, 9 or 10 days in a row. It's just been a phenomenal run to the upside. As a result, we have many products that are very overbought in the near term. I'm not saying the top is in. I'm not saying the market can't head higher here going into the summer months. I just think in the near term, over the next few weeks, we could certainly see some of these names begin to consolidate or even pull back. And I think Apple is at the top of the list. It's almost $1 trillion company, right? Now, again, it could continue to head higher from here, but I think in the near term, we are definitely due for a slowdown. And here's why I'm justifying this type of an outlook. If you take a look at this 195-minute chart, for those of you that are not familiar with this time frame, it essentially gives you two candles a day instead of one. The daily chart that we look at times, it's fine. It's pretty slow. It takes a lot to get a setup there. So to speed it up a little bit, I'd like to use this 195-minute chart. On this chart, you're going to see some standard deviation channels here. So you'll see the white line, you'll see the dashed yellow lines, the red line, and then the white line up above. With the recent price action, you can see here over the past couple of days, we crossed up above the second standard deviation channel that I have on the chart. We're between a 2 and a 3 standard deviation move here on the 195-minute chart. When I see that happen, I know that that indicates a very overbought condition. The chances of Apple continuing to move to the upside at the pace that it has gone over the past 10 days, very slim. Okay, the odds are really against that. So I'm looking to put on more of a neutral to bearish type of a trade. Notice I'm not going to talk about buying a put or buying a put spread here, because if I buy an option, I have to have Apple move to the downside immediately. If it doesn't, the time decay is really going to start to eat in to any profit potential that I have. So I'm going to take a look at selling a call spread here. Selling a call spread, still a bearish position. We just have a little bit more of a neutral kicker there, because if Apple does not move lower in a big way, let's just say we kind of consolidate sideways, or maybe we drift to the downside from here, I can make money from that by selling a call spread. So again, the initial premise for this trade is Apple is overbought. I'm seeing that by us passing the second standard deviation channel here on the 195-minute chart. It's been a phenomenal move. I'm going to look to anticipate a slowdown or even a pullback. So I'm going to go over to the trade page here. With Apple being one of the most liquid products in the world, we have a lot of flexibility with the different expiration cycles that we use. We can use the weeklies, we can use the monthlies. Really doesn't matter here. There's plenty of volume and open interest in many different areas. But I was looking here today at the June 8th weekly options. They have 28 days left. Now, why am I going out a full 28 days when compared to some of these other weekly cycles in here that have, 14, 21 days left? Why wouldn't I go with a shorter time frame? The issue that we're running into is over the past couple of weeks, the market has moved higher. During that stretch, the VIX has gotten crushed. The volatility has been sucked out of this market because it goes higher every day again. So if we take a look, let me shrink this down a minute. You'll see that the IV percentile on Apple is at 30. When it's below 50, when it's below that 50th percentile, that indicates to me that the options are cheap. There's not a lot of premium there to collect. So in order for me to collect enough premium to give myself a good reward to risk ratio, I've got to go farther out in time. So it's not the ideal scenario for us. Ideally, I would like to trade those shorter term options. There's just not enough juice in the options. There's not enough premium for us to collect there to make it worth our while. So I'm going to go out to the June 8th options, the weekly cycle with 28 days left. I'm going to take a look at the out of the money call options. I want to sell some junky out of the money calls that have a lower probability of success. Now, I'm also going to come in and buy some out of the money calls as well to make it a risk defined trade. Because again, with Apple so strong, if it continues to move to the upside here and I'm dead wrong on my outlook, I don't want to be faced with a large loss. I'd rather define my risk up front. So I'm going to come to the out of the money calls. I'm going to go to the 192.5 calls. I'm going to right click on those. I'm going to go to sell, and I'm going to go to vertical. So I'm just going to sell a very simple call spread here. Nothing overly complex here. I'm just selling an out of the money call option, I'm going to go further out of the money and buy a call option to make it a risk defined trade. So I'm selling the 192.5 call and I'm looking to buy the 195 call, and that's going to make it a risk defined trade. For this position, it's currently trading for around 83 cents mid price. It just moved up to 84. So let's lock it in at 84 and let's take a look at the profile of this trade. So I'm collecting 84 cents or $84 per spread up front to put this position on. That's the most I can make on the trade, regardless of what happens on Apple. So if it completely falls apart, let's say Apple pulls back by $10 here over the next couple of weeks. The most I can make on this trade is $84 per spread. Now, here's why I'm attracted to this position. I'm only risking $166 to put the trade on to begin with. If you've got a smaller account size, you might be intimidated by trading a $200 stock like Apple. Well, we can put this position on for less than $200 per spread. With it being so liquid, if you've got a larger account size, you can put this thing on 20, 30, 40 times. You're not going to have any problems getting filled. And we can do some simple math here. You put this thing on 10 times, you go from having $84 of profit potential to almost $900. You have $840 of profit potential. So it's a really nice way to generate some really solid income here and have multiple ways of making money on the trade. I don't have the home run profit potential that I would have if I just bought an outright put option. That put option is going to give me way more profit potential, but it only has one way of making money. Apple would have to move to the downside in a big way, and it has to happen quickly. With this short call spread, I've got 5 ways of making money on the trade. My break-even point here on the screen is at 193.34. That is calculated by taking my short call strike, the 192.5 call that I'm selling. I'm adding on the credit that I'm receiving to put on the trade. So I'm adding on 84 cents. That gives me my break even. So now I don't care if Apple moves up, down, or sideways. As long as it stays below that number, even if it's by a penny or two, I can still make money. So I have 3 different ways directionally that I can make money on Apple. Again, this is more of a bearish trade, but if I'm dead wrong, I've got a little bit of wiggle room here. It could move to the upside all the way up to 193.34, and I'm still okay. I can still make money. I also make money from time decay adding up. So the longer I hold this trade, every day that passes, that time decay is working in my favor. And then I also make money if volatility decreases. Now, am I expecting volatility to decrease much more than it already has? Probably not. So in theory, if it does, that gives me a 5th way of making money. I probably don't have that benefit in this case because the volatility has already contracted so much. I'd probably give up one way of making money. So I've got 4 or 5 ways of being profitable on this trade. It's still a very high probability type of a trade. Now, some people push back on these types of positions and say, okay, the trend is clearly to the upside on Apple. Why would you try to fight it? Well, we all know that markets long-term move in a stair-step fashion, right? They're going to move forward 2 steps and they're going to pull back. I think Apple's already made 2 ginormous steps forward. I'm expecting a pullback here. Okay, I'm expecting a pause. And again, if I'm dead wrong, I'm out $166 per spread. It's not a large loss. So we got a lot of factors working in our favor here. Okay, I like the pricing here. We're risking 2 to make 1, which is very typical for us. When I sell a spread, I'm typically risking 2 or 3 to make 1. And the reason I'm willing to accept that ratio is because I have those 5 ways of making money on the trade. I have a very high probability of success. All right, so we shouldn't have any problem getting filled on Apple here today. Once we have the position on, the beauty here is we don't have to watch it very closely. It's not a position that I have to watch every moment of the day. I'm going to come in periodically with 28 days left. I might come in once a day, check this trade, just make sure I'm below my break-even point. As long as I am, I don't need to dissect chart patterns, draw trend lines, put multiple indicators on the chart. All I have to do is make sure that we're below that break-even point, and I'm just fine. Now, how would I manage this trade? What is my profit target? Anytime that I sell a spread, I'm targeting 50 to 75% of whatever I collect to put the trade on. Okay, so that 84-cent number that I'm collecting to put this trade on, again, that's the most I can make on the trade. My initial target zone, okay, is between 21 and 42 cents. If I can buy this thing back between 21 and 42 cents, I'm willing to do that. If I hold all the way to expiration, I could book the entire $84 of profit. The problem with that is the closer we get to expiration, the gamma also increases, meaning the options are going to start to react faster to changes in stock price. So I could be profitable for the first 20 days of this trade, and then in the last week before expiration, if we get a reversal, I could go from a really nice profit to a full loss immediately. I'm not willing to run that risk. If I can book 50 to 75% of my maximum profit potential, I'm going to do so. I'm going to ring the register, free up the capital for the next new trade, and not have to worry about expiration week. A lot of times people like to hold expiration because if the whole thing expires worthless, you don't have to pay the commission to close out of the trade, which is great. But with commissions so low these days, I'm not going to let that dictate my trade management. So again, if I can book a partial profit here, I'm going to do so, especially, if the next couple of weeks, if we get a pullback on Apple, where I can book that partial profit, I'm going to do so because, again, I'm not expecting a large pullback on Apple. I just think it's too strong here long term. But again, over the next couple of weeks, could certainly see a nice healthy pullback. So that's what we're positioning ourselves for with this type of a trade. Right, so we'll see if we can get filled here today. We'll start to manage it going forward over the next few weeks. Just wanted to give a quick update on some of our open positions that we've talked about here the last few weeks. So going back into last week's options trade of the week, we looked to sell a put spread in JP Morgan, and we came out to the May 25th options. We sold the 107 and 106 put spread, and we collected 32 cents or $32 per spread. We closed that trade out here earlier this week. We closed it out for 8 cents. So we booked that 75% of maximum profit potential like we just got done talking about on Apple. So it gave us a $24 profit per spread. Doesn't seem like the largest profit there, but remember, I only tied up $68 of capital per spread to put the trade on. So you could put it on 10 times and still have less than $700 of risk. You put it on 10 times, you've got a nice $240 profit in less than a week's time. So it was just a really great trade. Didn't really take that long either. Didn't take a lot of patience. We were in and out within a couple of days, and we're now flat on JP Morgan. The other open trade that we have on, we sold the 435, 440 call spread on CMG. You can see CMG currently today trading for 425. These options are expiring next week, so we've got to watch this thing closely. What I need to have happen on CMG, if we just sit right here, I'm okay. We need the CMG to stay right below 435. So if it stays right here, I'm okay. If it moves down, I'm okay. If it moves slightly higher from here, I'm okay. The one time I have to be concerned is if over the next week, if we get a big move up above 435, that's when I would have to take action. So it's doing exactly what we need it to do. When you sell a spread, obviously when you're selling a call spread, I want that stock to move to the downside. It really hasn't. It's basically just moved dead sideways, which I'm okay with. That's the beauty of selling a call spread. I can be dead wrong on direction. I can still make money from the time decay adding up. So we'll have to continue to be patient here. We're up small on this thing. We're profitable, but just barely. I do need, ideally going into next week, if we could have a session where we're down $5 or $6, that would work wonders for this type of position. We should be able to close it out. So we sold that trade for $2 per spread. So if I can buy this thing back for between 50 cents and $1 here over the next week or so, I'm going to do that. So you could even place a closing order if you wanted to. Place that order for 50 cents, place it as a GTC or a good till cancel. That way it's working over the next week. And if we can get filled at that number, great. It just doesn't take a lot of attention to detail. It doesn't take a lot of time to manage the position. All right, so we continue our really nice stretch here with our options trades of the week. I mean, it's just been a phenomenal couple of months for us with our options trading. And it's going to become a little bit trickier going forward if the volatility stays low. We just touched the 12 handle on the VIX this week. Ideally, I'd like to see that number closer to the mid-teens. So that would make it a little bit more easier for us going forward over the next few months. But we'll see. We'll just continue to take what the market's given us here, see if we can get that pullback on Apple, get the pullback on CMG next week. That way we can close out of those trades with some nice profit. So as always, if you have any questions at all on any of these trades, feel free to leave a comment here in the blog, leave a comment on the video, or email me directly. My email is mike@netpicks.com. All right, so I'm going to wrap this video up here. Enjoy your weekend, everybody. I'll be back here next week with our next new option trade of the week, and we'll also manage our CMG and Apple trades. All right, we'll talk to you then.